The headlines flashed with quiet urgency. Beijing's bond bonfire. The Great Wall of Selling. On January 15, 2026, a shift long in the making finally surfaced. In Shanghai's trading rooms and the People's Bank of China, China began quietly liquidating its vast U.S. Treasury holdings. The first signs were subtle, minor market ripples, a slight uptick in U.S. borrowing costs. But as data emerged, it was clear. This was a deliberate, strategic retreat from the dollar. For years, China held a mountain of U.S. debt, wielding immense leverage. Now, it was cashing in those chips, not for a quick win, but as a calculated exit from a game it no longer trusted. There was no panic, just precise, algorithm-driven sales, executed in the dead of night. This was financial warfare, each sale a small cut in a much larger operation. Central bankers in Frankfurt and Tokyo downplayed the moves, but inside the Federal Reserve, alarm bells rang. The world's largest buyer of American debt was becoming its biggest seller. This was more than a financial transaction, it was a geopolitical statement, a challenge to the US-led order. For decades, nations lent to the US in exchange for the safety of the dollar. China's actions signaled a loss of faith in that system. The sell-off was a message to the world. American financial dominance was no longer a given. The tremor had begun. The earthquake was yet to come. The global order was shifting quietly but unmistakably. The world was watching and waiting for the aftershocks. In the 21st century, the most decisive battles are fought not with tanks, but with financial firepower. While military displays grab headlines, the real power lies in the digital ledgers of global finance. China's gradual divestment from U.S. treasuries is a masterclass in economic leverage. By reducing its exposure to the dollar, China insulates itself from U.S. sanctions and pressure. Selling U.S. bonds quietly raises America's borrowing costs, applying slow, relentless pressure. Unlike a naval blockade, a financial blockade is invisible and far more insidious. This is a weapon that requires no army, only strategy and patience. The effects are profound. Washington finds it more expensive to fund everything from defense to social programs. The rules of power are being rewritten. Military might is no longer enough. China's actions signal a new era where financial independence is the ultimate shield. The era of economic interests trumping strategic rivalries is over. The silent weapon of finance has been drawn. The world's balance of power is shifting, one bond sale at a time. The scale of China's retreat is staggering. At its peak in 2013, China held $132 trillion in U.S. treasuries. Now, official holdings have dropped to around $775 billion, a reduction of over $500 billion, but the real number may be even higher, hidden by offshore custodians in Belgium and Luxembourg. Experts estimate China may have offloaded as much as $688 billion or more. This isn't a minor adjustment, it's a structural unwinding of a historic financial position. The process has been slow and tactical, accelerating during geopolitical tensions, then pausing. China's strategy, boil the frog, turning up the heat so gradually that the US financial system barely notices until it's transformed. For years, global savings flowed into US debt, keeping rates low. China was the linchpin. Now, it's methodically removing itself. The hundreds of billions once destined for treasuries are being redirected. The numbers don't lie. The world's de-risking from the US with China leading the way. This is not a forecast, it's happening now in the cold, hard figures of global finance. The great unwinding is real, and its consequences are just beginning. China's decision to divest from U.S. debt was triggered by a series of shocks. The trade war signaled that the U.S. would use economic power as a weapon. Tensions over Taiwan deepened Beijing's concerns. The West's sanctions on Russia, freezing central bank assets, were a wake-up call. China realized its U.S. treasuries could become a hostage in any future conflict. The dollar's weaponization turned a safe asset into a strategic risk. The need to de-risk became urgent national security. The trust that underpinned the US-China financial relationship was shattered. The benefits of holding US debt no longer outweighed the risks. The sell-off was a defensive maneuver, not aggression. China refused to leave its economic fate in the hands of its main rival. The financial lever was pulled, out of necessity, not choice. China's strategy is clear: build a new economic order, free from US dollar dependence. The sell-off is about more than assets, it's about sovereignty. By reducing dollar holdings, China minimizes U.S. leverage over its economy. The goal: strategic decoupling and economic self-reliance. China is also promoting the yuan, establishing currency swaps and pushing for yuan-denominated trade. Every bond sold is a step toward a multipolar currency world. This is about building a parallel financial sphere, independent of the West. Economic security is national security, core to Xi Jinping's vision. The move away from the dollar is central to China's push for rejuvenation. The Dragon's Gambit is a patient, multi-decade project for true independence. China no longer trusts the American-led order. It's preparing for a world of more friction and less trust. The global balance of power is being reshaped by design. As China sells U.S. bonds, it's buying tangible assets. Gold is the top target. China's central bank is on a historic gold buying spree. Gold can't be frozen or devalued by foreign governments. It's the ultimate safe haven. But China's pivot goes further. It's stockpiling industrial metals like copper, lithium, and cobalt. These resources fuel China's tech ambitions and give it leverage over future supply chains. China is also amassing huge food reserves, wheat, corn, and more, to ensure stability. The shift from paper to physical assets is about resilience, not just returns. It's a fundamental distrust of a debt-driven digital financial system. China is trading the abstract for the real, the virtual for the tangible. This move is driving up global commodity prices and signaling a new era of resource competition. China aims to be the world's warehouse, not just its banker. With China stepping back, the US has turned to its allies to buy its debt. Japan, the UK, Belgium, and Ireland have ramped up their treasury purchases. The debt market is now sustained by political loyalty, not just economic logic. For these allies, supporting the dollar is about security and alliance, not profit. Their bond purchases are a financial contribution to the alliance, but this creates new vulnerabilities. Their willingness to buy is tied to diplomatic relations, not returns. A political rift could trigger a funding crisis for the US government. The US now depends on the goodwill of friends, not the self-interest of rivals. The Treasury market has become an extension of foreign policy. This system is less stable than before. Alliances can shift. The US is more dependent than ever on its partners. The global order is now propped up by political ties, not just economic fundamentals. The stakes have never been higher. The new system, where allies buy US debt, rests on shaky ground. Political will is far more volatile than economic self-interest. China bought treasuries for commercial reasons. Today's buyers are motivated by politics. If a key ally faces crisis or a diplomatic rift, they could sell off US debt, triggering market turmoil. The system is fragile. Any crack in loyalty could spark a broader sell-off. The US may feel pressured to make foreign policy concessions to keep allies buying. Reliance on a few buyers makes the market more vulnerable to shocks. For ordinary people, this means more uncertainty. Borrowing costs now depend on global politics. A distant diplomatic spat could raise your mortgage rate. The Treasury market's old stability is gone. It's now held together by alliances, not mutual economic benefit. The risks are real, and the consequences could be felt everywhere. The foundation of the global financial system has changed permanently. China's treasury sell-off marks the dawn of a multipolar financial era. The unipolar dollar world is over. Competition and instability are the new normal. The lesson: diversify. Nations, investors, and individuals alike. Governments must avoid over-reliance on any single currency or creditor. The US must reduce its dependence on foreign lenders. Political loyalty is not a long-term solution. For investors, the risk-free asset is no longer risk-free. Geopolitics now shapes bond values. Diversification and tangible assets are crucial hedges. For ordinary people, this means higher rates, more inflation, and greater uncertainty. Build personal financial resilience, reduce debt, save more, prepare for volatility. The tremor that began in Beijing has shaken the global system. Navigating this new world will require vigilance, adaptability, and a new mindset.